Interestingly enough, 100% of the cities expect to grow. Hi, this is the Business Guy. So what's going to happen to the housing market in 2023? We're going to cover the real estate sales forecast from chief economist at the National Association of Realtors. And we're also going to talk about the top 10 hottest real estate markets forecast for 2023 and beyond. And then we're going to cover the 10 reasons why these areas of the country are expected to increase in price more than the rest of the country. We'll also talk about the what's expected in the market, which area of the market is expected to drop the most, and the prices will be fairly stable in 2023, except certain areas of the country, which we'll talk about. So what are the hottest markets? We'll talk about that in a bit. And if you appreciate this information, please click the like button below so YouTube promotes this video. Many thanks. And you can also click the subscribe button if you haven't already, so that when more videos come out like this one, you'll be up to date right away. So the key highlights are the National Association of Realtors predicts 4.78 million existing home sales in 2023, and that's down 6.8% from 5.13 million in 2022. So the increased interest rates naturally going to hurt the volume of home sales. Annual median home prices are expected to increase in 2023 by just 0.3%, except certain areas that are exceptions, which we'll talk about, following a 9.6% gain in 2022. And the number one source of this information on this topic is from the National Association of Realtors and their top dog. It's Chief Economist Lawrence Yun, Y-U-N, and he's also the Senior Vice President of Research. So they unveiled the association's forecast today during their 4th annual year-end real estate forecast summit. And they predict that home sales will decline by 6.8% compared to 2022 to 5.13 million, like I said. And the median home price will be $385,800. And like I said, an increase of 0.3% from this year, where it's $384,500. So Yup says half of the country may experience small price gains, while the other half may see slight price declines. It's interesting to see which parts of the country, they're kind of in a specific region, are expected to increase. However, markets in California, get this, may be the exception, with San Francisco, for example, likely to register price drops of 10 to 15% in 2023. So Yun expects rent prices to rise by 5% in 2023. So 5% increase in rent prices next year, following a 7% increase in 2022. He predicts foreclosure rates will remain at historically low levels in 2023, comprising less than 1% of all mortgages. Interesting. And Yun forecasts, and I think it's probably because the supply is still not meeting the demand, the supply of housing. We're still, about 6 million houses short of what we really need. So that's one of the reasons why the prices aren't expected to crash in most of the country, except for San Francisco. Yun forecasts the U.S. GDP will grow by 1.3%, roughly half of the typical historical price of 2.5%, okay, after eclipsing 7% in late 2022. He expects the 30-year fixed mortgage rate to settle at 5.7% as the Fed slows the pace of rate hikes to control inflation. They just did a raise just this week, as you know. And Yun noted this is lower than the pre-pandemic historical rate of 8%. Okay, here you go. The top 10 real estate markets to watch in 2023 and into the future. So the NAR identified 10 real estate markets they expect to outperform other metro areas in 2023. So here are the markets in order, with the first area expected to grow the most and then down to the least, but they're still expected to grow. Number 1, Atlanta, Sandy Springs, Marietta, Georgia. So the Atlanta, Georgia area. Number 2, Raleigh, North Carolina. Number 3, Dallas, Fort Worth. Next is Fayetteville, Arkansas, and as well as Missouri in that area. So Fayetteville, Springdale, Rogers, Arkansas, and Missouri, those areas. Greenville, South Carolina. Charleston, North Carolina, and as well as parts of South Carolina. And Huntsville, Alabama, another area expected to grow. Jacksonville, Florida, which happens to be the largest landmass city in the entire country, most populated city in Florida as well. Jacksonville is kind of up there by Georgia. San Antonio, Texas, and finally Knoxville, Tennessee. So those are the areas expected to grow. Now notice something. I want to show you something here. I thought it was kind of interesting. If you look at the area, the region here, let's take a look at the iPad here. So, okay, here we go. So if we take a look at where these cities are, if we draw a line right in the very, very middle of the country is Lebanon, Kansas. So that's represents that red little marker there. Lebanon, Kansas is the very center of the country of the mainland. Okay. Well, 100%. Interestingly enough, 100% of these cities expected to grow are in this area, this quadrant, the southeast section of the country. All of them, every one of them. Okay, like San Antonio, that's pretty close to here, but it's still inside. So we're talking about South Carolina, North Carolina, some areas in Florida, anyway, all of these areas are in this southeast quadrant of the country. So think about that. If you want to invest in real estate, that may be something to consider. So we're going to talk about also. We're also going to talk about the 10 reasons why these areas are expected to grow in just a minute. So Yoon goes on to say the demand for housing continues to outpace the supply. Like I just said, the economic conditions in place in the top 10 markets, all of which are located, like I said, in the southeast, provide support for home prices to climb by at least 5%, okay, in 2023. NAR selected the top 10 real estate markets to watch in 2023 based on how they compared to the national average among the following economic indicators. Here are the 10. Number 1, better housing affordability. Number 2, greater numbers of renters who can afford to buy a median-priced home. Number 3, again, the reasons why these are in the top 10. Number 3, stronger job growth. A lot of the New Yorkers, they want to be in the warmer climate. And hey, if you can work remotely, why the heck stay in, freeze your butt off land, when you can, move to. And, here's a stat for you. It's pretty amazing, especially I live in Florida now, but I grew up on the West Coast, Oregon, Washington, California, lived there for 20 years before I moved to Florida. And what I found, I was pretty amazed to find that 80% of the U.S. population lives in the Eastern and Central time zones. 80%. Okay, so and so a lot of the freeze your butt off people. I mean, this time of year, every year you see this crazy snow in the Northeast. Well, people want to move down south where it's warmer. If you can work remotely, why not? So number 4, faster growth of information industry jobs. There's a lot in Huntsville, Alabama that's like high tech. I wouldn't have thought it, but my son was telling me about it since my son is in high tech. Huntsville, Alabama, big. Parts of the Space Coast, big, of Florida. Number 5, higher shares of the information industry in the respective local GDPs. So the information industry and local gross domestic product. Number 6, migration gains. Like I said, people in the cold states want to live in the warm states. That's why I'm in Florida. Number 7, share of workers teleworking. Yep, that's another thing. I didn't read this list beforehand, but kind of going right along with it. Number 8, faster population growth. Yep. Number 9, faster growth of active housing inventory. And finally, 10, smaller housing shortages. When we moved to Florida 8 years ago, it was the 4th largest state, most populated. Now it's the 3rd most populated state. Now, Nadia Evangelou, senior economist and director at real estate research for the National Association of Realtors, meanwhile, envisions 3 different rate scenarios to occur next year. Now, scenario number 1, inflation continues to remain high. So there's 3 different scenarios and kind of give you an idea of what might happen in the future, predicting the future here. Inflation remains high, forcing the Fed to keep on raising interest rate. This means the mortgage rates will keep climbing, possibly near 8.5%. Hey, my first house, the interest rate was 9.5%. My very first house I ever bought with my wife. That is, I bought a house before we met, but first house I bought with her was the second house I ever bought in my life. So that's scenario number one. Inflation continues to be high, and they keep hiking the rates. Scenario number two, the consumer price index responds more to the Fed's rate hikes, and there is a gradual deceleration of inflation, causing mortgage rates to stabilize near 7 to 7.5% for 2023. Scenario three, the Fed raises rates rapidly to curb inflation, and the economy falls into a recession. That's what I'm concerned about. This could cause rates to likely drop to 5%, she explains. So, will housing sales decline? Each of Evangela's three scenarios for mortgage rates would have a major impact on home sales. In each case, sales will slow down. It's just a question of how much. Now, higher rates under scenario number one could cause home sales to drop by more than 10% next year, she continues. In scenario number two, home sales drop by 7% to 8%. And in the third scenario, home activity may also drop further by more than 15%. Experts agree, the slowdown in home sales that's been occurring all year will continue into 2023. And Shigara, another researcher in the real estate industry, believes existing home sales in 2023 will slow, likely hovering around 4.5 million range, which kind of coincides with what we just talked about with the other forecast, with new home sales, as opposed to existing, at around 600,000 units. Okay, listings may no longer go at lightning fast pace either. Like they did when people were lined up, outbidding each other. It's crazy for a while there during the COVID interest rate drop. Days on the market have been climbing back toward more normal levels recently, and we could see them approach them in 30 days or more in. So the time to sell, 30 days or more in 2023, in the market as the market continues to cool down, he says. Shirshakov has similar ideas with those sentiments. The average days in the market will continue to increase somewhere between 2 and 3 times the current levels. So the dog-eat-dog world of real estate buying, it's going to become more of a buyer's market than a seller's market, as it has been for last couple of years at least. Okay, what will happen to home values? And this is another forecaster, so we get different perspective. Interesting in what they say. Interestingly, due to low inventory, home prices won't drop in 2023 due to low inventory, Evangelou predicts. I expect the pricing to be relatively flat, increasing by only 1 percentage point. Johnson, though, feels that higher interest rates will undoubtedly hurt home values and pricing. A soft real estate market with levels lower than current levels will result, Johnson says. That's not great news for sellers, but welcome news for house hunters. There are plenty of potential buyers still patiently waiting to enter the home market. Assuming the prices increase, you'll start to see some of these buyers emerge. Essentially, all cash or lower loan-to-value purchasers who are less impacted by interest rate concerns, explains Scott Kriske, a partner at the residential banking department of Romer Dabas. It's a Manhattan real estate law firm. Home values on a national level are most certain to decline to levels modestly, perhaps between 5 to 10%, according to Sharga. And some of the more expensive markets will potentially see larger declines. So just like we said, some areas are going to drop, and especially San Francisco area. Some of the more expensive markets will potentially see larger declines, and the existing inventory, strong credit quality among current mortgage holders, and demand from young adults looking to become homeowners should help prevent prices from falling even further, says Sharga. Okay, will housing inventory increase? A shortage of homes has helped fuel the frenzied market in the last few years. I mean, during the COVID thing, and they couldn't build. They weren't supposed to be out there, people around each other. They're supposed to isolate. So, they sent the builders home. Government was sending them money. And then it says, but experts differ on housing inventory projections for 2023. Before the housing crash of 2008, inventory peaked at about a 13-month supply. So 2008, you had this big glut of homes. You don't have that now, okay? Real estate prices crashed then because, supply and demand. You had a huge supply, so prices crashed. You don't have that here. So according to Sharga, and that's the fact. Today, we have about a 3-month supply as opposed to a 13-month supply in 2008, which is about half of what we need. Current homeowners are unlikely to trade in their 3% mortgage for a new home at 7% loan unless they absolutely have to. So existing home inventory should remain low. I mean, who wants to sell their house when we have a 2.5%? It's it's pretty small, so I don't feel like paying the thing off because 2.5% money is pretty good, even though I'm not a fan of debt. And builders have scaled back on housing starts for the past 3 months. That means we're not likely to see a huge boost in supply from new construction anytime soon either. But others foresee increased supply next year with builders building. Housing inventory should rise throughout 2023 as homes become more affordable due to higher rates. Okay, that's your forecast for 2023. That's what they say should happen. And there you go.